Imagine you become the CEO of a company that earns $1 billion in net profit every single year. Now pause and ask yourself one critical question. What would you do with that cash? What would you do with that money? This single decision will determine the destiny of your enterprise. Would you build new factories, develop better products, or perhaps acquire another company to eliminate competition? Reduce debt, pay dividends to your loyal shareholders, or buy back your own shares, keep cash for the future? Every one of these decisions changes the future of the business. It shapes your competitive advantage for decades. Professional investors understand something that many beginners overlook. Making money is important, but allocating it is crucial. Capital allocation is the process of deciding where a company's money should go to maximize shareholder value. Think of it as managing a family budget, but with millions or billions of dollars. If every dollar is spent wisely, your wealth grows. If wasted on bad projects, opportunities vanish. Companies face the same challenge. Every dollar earned can only be used once. There are no second chances. Professional management constantly asks, where will this dollar create the highest long-term return for our owners? That single question, answered repeatedly over years, influences shareholder wealth more than any product or service. Most companies use capital in 5 primary ways. Understanding these choices is absolutely critical for any serious investor who wants to evaluate management's strategic capabilities and long-term vision. Option 1 is to reinvest in the business. This means building factories, developing software, and expanding. It includes hiring talent and investing in research. If these yield high returns, shareholder value grows organically. Option 2 is to acquire another company. This can accelerate growth and buy market share instantly. However, poor acquisitions destroy billions of dollars every year. Integration is complex and often fails. Option 3 is to reduce debt. Lower debt strengthens financial flexibility and lowers interest costs. Especially during economic downturns, a clean balance sheet is a massive competitive advantage for survival. Option 4 is returning capital to shareholders through dividends, offering regular tangible cash payouts. This is popular with income-focused investors who want immediate returns. Or through share repurchases, which increases each remaining shareholder's ownership percentage of the business. We will study both of these options in deep detail shortly. Option 5 is to hold cash. Sometimes the smartest decision is to do nothing and wait. Cash provides flexibility, and flexibility creates opportunity when market valuations eventually drop. Every dollar has a job. Many investors love dividends. Receiving cash is satisfying, but professionals look at the opportunity cost. Can management generate higher returns by keeping the money inside the business? That is the question you must ask. Company B reinvests every dollar at very high rates of return. If reinvestment creates more value than distributing cash, shareholders benefit more over time. Great capital allocation means choosing the option with the highest long-term value creation. Sometimes that is reinvestment, sometimes it is returning cash. You must evaluate the math with clinical precision. Share buybacks are often misunderstood. By repurchasing shares, the total number outstanding decreases. If performance is stable, each remaining shareholder owns a larger percentage of the company. It's a silent victory. You own a larger piece of the corporate pie without spending an extra dollar of your own money. It is a powerful way to compound value silently for those who understand the mechanics of ownership. But buybacks only create value if the stock is undervalued. If management repurchases shares at excessively high prices, they are actively destroying your hard-earned wealth. Valuation is the only thing that matters. If management buys high, they waste capital. Professional investors evaluate the timing and price of repurchases carefully. They look for disciplined execution, not mechanical blind programs. Price is key. History is full of expensive, value-destroying acquisitions. Many looked great on paper but ended in complete disaster for shareholders. Empire-building CEOs often destroy billions in pursuit of pure size. Integrating culture, technology, and customers is incredibly difficult. Most mergers fail to achieve the promised synergies and savings, leaving long-term shareholders to pay the price of management's hubris. Does management have a disciplined strategy, or are they chasing growth at any price? True discipline is rare, and corporate history is full of warnings. You must analyze the record, not the promises. The key metric to watch is return on invested capital, or ROIC. It measures corporate allocation efficiency. It shows how effectively a company turns capital into net profits. It is the number of truth. Imagine 2 companies invest the same amount. One generates much higher profits. That business is using capital more efficiently, compounding wealth faster for you. This is the difference between winners and losers. Look for consistency over decades, not just one lucky year. True economic moats endure the test of time and competition. Consistent high ROIC is the undeniable signature of quality and management talent. Legendary CEOs like Henry Singleton and Warren Buffett are famous for their masterclass capital allocation strategies. They ignored Wall Street trends and focused entirely on compounding cash per share for owners. They treated every dollar of corporate earnings as shareholder capital, deploying it with extreme discipline and patience. Their records speak for themselves and provide our ultimate guide for evaluation. Before investing, ask, how has management used cash? Have acquisitions created real, measurable value for owners? Was debt managed responsibly? Were share repurchases done at attractive prices? Use a checklist. Let history guide your decisions. Demand a clear track record of intelligent capital allocation before risking your hard-earned capital. The checklist is your primary shield against corporate mediocrity. Outstanding businesses earn profits. Exceptional businesses allocate them wisely. Subscribe to Wealth Entertainment 21. Turn on notifications for Lesson 6 on free cash flow. Allocation is destiny for your portfolio. To truly master this discipline, let us analyze the legendary case of Henry Singleton at Teledyne. This is widely considered the absolute gold standard of corporate capital allocation in the modern era. Between 1972 and 1984, Singleton did something unprecedented. He repurchased a staggering 90% of Teledyne's outstanding shares in the open market at bargain prices. He executed this massive program because he recognized that the public markets were severely undervaluing his company's true long-term earning power and cash generation. He saw what others missed. While Wall Street analysts heavily criticized his actions at the time, Singleton proved them completely wrong. He created extraordinary, life-changing wealth for his loyal, long-term shareholders who stayed the course. Now compare this masterful strategy to Berkshire Hathaway, where Warren Buffett has consistently and famously refused to pay a single dollar of dividends to his shareholders since he took control. Instead, Buffett redeploys every single dollar of corporate profit back into high-return subsidiaries and stock acquisitions. This is the ultimate example of elite compound growth and allocation skill. This is the crucial difference between average corporate management and elite capital allocators. They do not follow popular Wall Street trends. They follow the cold, hard mathematics of compounding and value. On the dark side of history, corporate records are completely littered with CEOs who let personal hubris and ego guide their massive capital allocation decisions. They chose growth over value every time. They routinely overpaid for glamorous acquisitions just to make their corporate empires larger, completely destroying billions of dollars in shareholder value in the process. Ego is the enemy of allocation. This destructive empire-building behavior is a direct transfer of wealth from your pockets to the seller's pocket. As a serious investor, you must learn to avoid these companies at all costs. As you evaluate your own stock portfolio, apply the rigorous three-step framework we have discussed today. First, look at the historical consistency of return on invested capital over many years. Second, evaluate how corporate debt is managed. Is it used intelligently for productive growth, or is it a ticking debt bomb waiting to destroy the company during the next inevitable downturn? And third, demand absolute discipline from the executive teams running the businesses you own. Their daily allocation choices will ultimately determine your future financial freedom and quality of life. Your financial freedom depends entirely on their capital allocation choices. Investing is not just about raw numbers, it's about the discipline and integrity of the people behind those numbers. At Wealth Entertainment 21, we are fully committed to bringing you the institutional-grade insights you need to succeed in any market. Stay disciplined, stay focused on the long term, protect your capital. This has been Lesson 5 of our Professional Investing Masterclass series. Thank you deeply for watching and for your trust. We will see you in Lesson 6 for our deep dive into cash flow. Let us break down the exact mathematics of return on invested capital. Net operating profit after tax divided by total invested capital. This simple formula is your ultimate truth detector for any business. When a company can consistently generate an ROIC above 15%, it possesses a structural competitive advantage. It is actively creating value, not just consuming assets. This is the key to elite wealth. Thank you for joining our elite community of serious investors. Keep studying the records, trust the math over the narrative, and master the market. We will see you in Lesson 6. Mastering allocation is mastering destiny. To understand capital allocation, you must also understand the cost of that capital. The weighted average cost of capital, or WACC, is the blended rate a company pays to finance its assets. If a company earns a return on its projects that is lower than its cost of capital, it is actively destroying wealth, even if it reports positive earnings. This is a critical trap. Therefore, elite investors always demand that return on invested capital exceeds the weighted average cost of capital by a wide margin. This spread is where true shareholder value is born. To ensure they only pursue high-value projects, great companies set internal hurdle rates. A hurdle rate is the minimum acceptable rate of return on an investment. It is a filter. If a proposed factory or acquisition cannot realistically clear the hurdle rate, management must reject it. This discipline keeps the company focused only on its highest conviction and highest return ideas. Unfortunately, average CEOs often lower their hurdle rates during boom times just to justify expensive acquisitions or expansions. This is a classic sign of late-stage corporate decay. Watch for it. We must also consider capital intensity. Different industries require vastly different amounts of capital to operate. A software company requires very little capital, while an airline requires massive investment. Low capital intensity businesses are highly prized by institutional investors because they can grow rapidly without needing to constantly reinvest cash into expensive physical machinery or real estate. In contrast, high capital intensity businesses must constantly spend just to maintain their current competitive position. They run fast just to stay in the exact same place on the track. Another crucial factor is the cash conversion cycle. This metric measures how fast a company can convert its investment in inventory back into actual cash in the bank. Speed is efficiency. A short cash conversion cycle means the company generates cash rapidly, which can then be immediately allocated to other high-return opportunities. It minimizes the need for external financing. If a company has a negative cash conversion cycle, it actually generates cash from its customers before paying suppliers. This is the holy grail of financial efficiency and strength. Let us address share buybacks once more in relation to stock-based compensation. Many tech companies issue massive stock grants to employees, which dilutes your ownership over time. Dilution hurts. To combat this dilution, intelligent management teams complete share buybacks, but you must verify if the buybacks are actually reducing the total share count or just offsetting dilution. Dilution offset is defensive. True value accretion only occurs when the total share count decreases significantly year over year. If the count is flat despite billions spent on buybacks, management is wasting your capital. For dividend investors, safety is paramount. Do not just look at the dividend yield. You must evaluate the free cash flow payout ratio to ensure sustainability of payments. Yield traps exist. A healthy payout ratio is typically below 60% of free cash flow. If it exceeds 80%, the dividend is at high risk of being cut during a sudden economic storm. A dividend cut is highly destructive to the stock price and your passive income. Demand a robust cushion of free cash flow to protect your yield under any market conditions. Safety first. Ultimately, capital allocation is a strategic masterpiece. It is the ultimate expression of business acumen. When you find a CEO who allocates capital like Henry Singleton, you buy and hold. Thank you for investing your valuable time with us today. Master the art of capital allocation. Trust the cold mathematics of growth. And we will see you in Lesson 6. Goodbye.